Yeah, I've got no idea where the market's going to go. I prefer it going down, but I haven't. My preferences have nothing to do with it. The market knows nothing about my feelings. Yeah, that's one of the first things you have to learn with a stock. You buy 100 shares of General Motors. Now all of a sudden you have this feeling about General Motors. I mean, if it goes down, you may be mad at it. You may say, well, if it would just go up to what I paid for it, my life will be wonderful again. Or if it goes up, you may say how smart you were and how you and General Motors have this love affair and everything. If you've got all these feelings, stock doesn't know you own it. Stock just sits there. It doesn't care what you paid. It doesn't care that you owned it or anything. So any feeling I have about the market is not reciprocated. I mean, it is the ultimate. Yeah, it is very cold shoulder we're talking about here. And anybody that is going to be a net seller, practically everybody in this room is more likely to be a net buyer of stocks over the next 10 years than they are a net seller. So every one of you should prefer lower prices. I mean, if you're going to be a net eater of hamburger in the next 10 years, you want hamburger to go down unless you're a cattle producer. And if you're going to be a buyer of Coca-Cola and you don't own Coke stock, you hope the price of Coke goes down. I mean, you're looking for it to be on sale this weekend at your supermarket. You want it to be down on the weekends, not up on the weekend when you're going to attend the supermarket. Your stock exchange is a big supermarket of companies, and you're going to be buying stocks. What do you want to have happen? You want those stocks to go down, way down. And, you will make better buys then. And later on, 20 years from now, 30 years from now, when you're in a period when you're dis-saving or when your heirs dis-save for you after you're gone, I mean, then you may care about higher prices. But I find people, that was one of the, there's a chapter 8 in Ben Graham's Intelligent Investor about the attitude towards stock market fluctuations. And that and the chapter 20 on the margin of safety are the two most important essays ever written on investing as far as I'm concerned. Because when I read chapter 8 when I was 19, I figured, I just figured out what I just said, but it's obvious. I didn't figure it out myself, though. It was explained to me. I'd probably gone another 100 years if I had still thought it was good when my stocks were going up. We want things to go down, but I have no idea what the stock market's going to do. I never do, never will. It's not something that I think about at all. When it goes down, I look harder at what I might buy that day, because I know there's more likely to be some merchandise there that I can use my money effectively in.